Ladies and gentlemen, stop what you're doing. I need you to pay attention to what just happened in the last 72 hours, because the financial world as we know it is about to enter a phase that nobody is prepared for. While you were scrolling through your feeds, while you were watching the stock market hit new highs, while you were being told that everything is fine, a series of events unfolded in the Middle East that has sent shockwaves through the deepest layers of the global banking system. And I'm not talking about headlines. I'm not talking about the surface-level geopolitical theater that they feed you on cable news. I'm talking about panic. Real panic. The kind of panic that happens behind closed doors in executive boardrooms when the risk models start flashing red and the derivatives desk realizes they're sitting on a ticking bomb. Asian guy here, and what I'm about to walk you through is not speculation. It's not conspiracy theory. It's the mechanical breakdown of a system that was held together by assumptions that no longer apply. Let me start with the surface event because that's what everyone saw. 3 days ago, tensions between the United States and Iran escalated to a level we haven't seen since January 2020. The details don't matter. What matters is the reaction. Within 6 hours of the news breaking, Brent crude oil spiked 4%. Within 12 hours, insurance premiums on tankers passing through the Strait of Hormuz doubled. Within 24 hours, 3 major European banks quietly pulled their credit lines from counterparties exposed to Middle Eastern oil logistics. And within 48 hours, JP Morgan, Goldman Sachs, and Deutsche Bank were on emergency calls with the Federal Reserve. Now you might be thinking, okay, tensions rise, oil goes up, banks get nervous. That's how it works. That's the playbook. But here's the problem. The playbook assumes that the system has buffers. The playbook assumes that banks have liquidity to absorb shocks. The playbook assumes that central banks have room to maneuver. And all 3 of those assumptions are false right now. Let me explain what's actually happening under the surface. Global banks are not neutral observers of geopolitical risk. They are deeply, structurally embedded in the oil trade. Every barrel of oil that moves from the Persian Gulf to Europe or Asia is financed by a web of letters of credit, trade finance agreements, and derivative contracts that sit on the balance sheets of the largest banks in the world. When those banks issue a letter of credit to an oil importer, they are essentially guaranteeing payment. They are saying, we will cover this transaction even if something goes wrong. And for years, that worked fine because the risk was manageable. The Strait of Hormuz stayed open. The insurance was cheap. The oil flowed. But the moment tensions spike, the moment there's even a whisper of supply disruption, the entire equation flips. Insurance costs explode. Counterparties demand more collateral. And the banks that underwrote those trade finance deals suddenly find themselves holding risk that they can't price and can't hedge. Now here's where it gets worse. The banks didn't just finance the oil trade, they bet on it. Over the last decade, as oil prices stayed relatively stable, banks sold trillions of dollars worth of derivative contracts tied to crude. They sold options. They sold swaps. They sold structured products that promised clients stable returns as long as oil stayed within a certain range. And those products were priced using models that assumed geopolitical risk was contained. But geopolitical risk is not contained anymore. The moment US-Iran tensions spiked, those models broke. The volatility indices for oil exploded. And every single derivative contract that was sold based on low volatility assumptions is now underwater. The banks are sitting on massive unrealized losses, and they can't unwind those positions because the market has seized up. Nobody wants to take the other side of the trade. Everyone is trying to get out at the same time. And when everyone tries to get out at the same time in a derivatives market, the price doesn't just move. It dislocates, it gaps, it creates air pockets where there is no bid and no liquidity. Let me give you the numbers because numbers don't lie. According to data from the Bank for International Settlements, there are over $14 trillion in outstanding oil-linked derivatives on the books of global banks. $14 trillion. That's not the notional value of oil in the ground. That's the paper exposure. That's the leverage. And a significant portion of that exposure is short volatility. The banks bet that oil would stay calm. They collected premiums for selling insurance against chaos. But chaos just arrived. And now the insurance is being called. The margin calls are hitting. The clearinghouses are demanding more collateral, and the banks are scrambling to find cash to post, because if they can't post the margin, the clearinghouse will liquidate their positions, and that forced liquidation will create a cascade that could take down the entire oil derivatives market. But it's not just the derivatives, it's the physical trade finance. Let me walk you through what happens when a bank pulls a credit line. Imagine you're an oil importer in South Korea. You have a contract to buy 2 million barrels of crude from Saudi Arabia. You don't have $200 million sitting in cash, so you go to a bank and you get a letter of credit. The bank says, we will guarantee this payment. The oil gets loaded on a tanker. The tanker starts moving. And halfway through the journey, tensions spike in the Strait of Hormuz. Suddenly, the bank gets nervous. The bank looks at the insurance costs. The bank looks at the geopolitical risk. And the bank calls you and says, We need more collateral or we're pulling the credit line. Now you're stuck. The oil is on a tanker in the middle of the ocean. You can't pay for it without the bank. And if the bank pulls the line, the entire transaction collapses. The seller doesn't get paid. The tanker sits in limbo. And the oil that was supposed to feed refineries in South Korea never arrives. Multiply that scenario by 1,000 transactions happening simultaneously, and you start to see the fracture lines appearing in the global supply chain. This is what the banks are panicking about. It's not just the price of oil. It's the flow of oil. It's the financing of oil. It's the entire machinery that keeps 70 million barrels a day moving from producers to consumers. And that machinery runs on trust. It runs on the assumption that banks will honor their commitments, that insurance will be available, that tankers will be able to pass through critical choke points without being attacked or detained. But the moment that trust erodes, the moment the Strait of Hormuz becomes a question mark instead of a certainty, the entire system locks up. And we are seeing the early signs of that lockup right now. Let me tell you what happened in the credit default swap market, because this is the canary in the coal mine. Credit default swaps are essentially insurance contracts on corporate debt. If a company goes bankrupt, the CDS pays out. And there are CDS contracts on all the major oil companies, all the major shipping companies, and all the major banks that finance the oil trade. In the last 72 hours, the cost of buying CDS protection on those entities has spiked by 30 to 50%. That means the market is pricing in a significantly higher chance of default. The market is saying, we don't trust that these companies are going to survive this shock. And when the CDS market starts screaming, the banks start listening, because the CDS market is where the smart money hedges. It's where the professionals go to buy insurance. And if the professionals are buying insurance at these levels, it means they see something coming that the rest of the market doesn't. Now, here's the part that should terrify you. The Federal Reserve cannot fix this. The European Central Bank cannot fix this. The Bank of Japan cannot fix this. Why? Because this is not a liquidity problem that can be solved by printing money. This is a structural problem. This is a supply chain problem. This is a geopolitical problem. You cannot print your way out of a closed Strait of Hormuz. You cannot lower interest rates and make oil magically appear in a refinery. The central banks have spent the last 15 years training the market to believe that every crisis can be solved with liquidity injections. Print money, buy bonds, suppress volatility, and everything will be fine. But this crisis is different. This crisis is happening in the real economy. It's happening in the physical world. And the physical world does not respond to monetary policy. Let me connect the dots for you, because the implications are staggering. If the Strait of Hormuz becomes unreliable, even for a few weeks, the global oil market fractures into regional markets. Europe cannot get oil from the Middle East, so it has to bid for oil from other sources. Asia cannot get oil from the Middle East, so it competes with Europe for alternative supplies. And the United States, which is now a net exporter of oil, suddenly becomes the swing supplier. But here's the problem. The US doesn't have the refining capacity to replace Middle Eastern crude in Asia. The US doesn't have the tanker fleet to move oil to Europe at scale, and even if it did, the price would explode because the entire market would be trying to reroute 70 million barrels a day through different channels. The arbitrage breaks. The price differentials between regions blow out. And the banks that finance the old system are left holding contracts that no longer make sense. This is why the emergency calls happened. This is why JP Morgan and Goldman Sachs were on the phone with the Fed. They weren't calling to ask for a bailout. They were calling to say, we need guidance. We need to know what the plan is. Because if this escalates, if the Strait of Hormuz actually closes, the losses are going to be catastrophic. And the Fed doesn't have a plan. How do I know? Because if they had a plan, they would have announced it. If they had a plan, they would have coordinated with the European Central Bank and the Bank of Japan to issue a joint statement reassuring the markets. But they didn't. Instead, we got silence. We got a 2-sentence statement from the Treasury Department saying they're monitoring the situation. That's not a plan. That's a confession that they don't know what to do. Now, let me talk about what this means for you. If you're holding financial assets, stocks, bonds, anything denominated in currency, you need to understand that the game just changed. For the last 2 years, the narrative has been inflation is falling, interest rates are peaking, the Fed is going to cut, and risk assets are going to rally. That narrative assumed a stable geopolitical backdrop. It assumed that supply chains would heal, that oil would stay between $70 and $80 a barrel, and that the global economy would muddle through. But that assumption is now in question. If oil spikes to $120 because of supply disruptions, inflation comes roaring back. If inflation comes roaring back, the Fed cannot cut rates. If the Fed cannot cut rates, the stock market loses its support. And if the stock market loses its support, the wealth effect that has been propping up consumer spending evaporates. But it's worse than that. If the banks start taking losses on their oil derivatives, if they start pulling credit lines from trade finance, the real economy takes a hit. Companies that depend on stable oil prices start missing earnings. Airlines get crushed. Shipping companies get crushed. Manufacturers that use oil as a feedstock get crushed. And when those companies start laying off workers, the unemployment rate starts ticking up. The Fed is trapped. They can't cut rates because inflation is rising. But they can't keep rates high because the economy is weakening. They're stuck in a stagflationary nightmare, and there's no good policy response. Let me tell you what the smart money is doing right now, because the smart money is not waiting for the headlines to tell them what to think. The smart money is looking at the derivative exposures, looking at the trade finance flows, and quietly repositioning. They're buying physical assets. They're buying energy stocks. They're buying gold. They're buying anything that benefits from supply shocks and currency devaluation, and they're selling financial assets that depend on stability and low volatility. The rotation is happening in real time, but it's happening quietly because the big players don't want to spook the market. They don't want to create a stampede. They want to get their positions in place first, and then they'll let the headlines catch up. Here's the brutal truth. The global banking system is not designed to handle a world where geopolitical risk is the dominant variable. It's designed for a world where finance is separate from geopolitics, where markets are efficient, and where shocks are temporary and manageable. But that world no longer exists. We're entering a world where geopolitics dictates finance, where supply chains are weaponized, and where the assumptions that held the system together for 40 years are breaking down one by one. The banks know this, the central banks know this, but they can't admit it publicly because admitting it would cause panic. So instead, they issue bland statements, they tell you everything is under control, but behind the scenes, they're scrambling. They're running stress tests, they're gaming out scenarios, and none of the scenarios end well. The US-Iran tensions are not going away. The Strait of Hormuz is not going to become safer. The oil market is not going to stabilize as long as this overhang exists. And the longer this drags on, the more embedded the dysfunction becomes. The banks will continue to pull credit, the derivatives will continue to unwind, the physical oil flows will continue to fracture, and at some point, the market will wake up to the reality that this is not a temporary shock. This is a structural shift. The system is fragile, the buffers are gone, the central banks are out of ammunition, and the next crisis is not going to be solved with a press release and a liquidity injection. It's going to require real adjustments in the real economy, and those adjustments are going to be painful. You don't wait for the mainstream media to tell you it's time to act, because by the time they admit there's a problem, it will already be too late. The US-Iran crisis is not just a headline. It's a signal. It's a crack in the foundation. And the banks see it. Stay alert.